Good afternoon, everybody. Welcome back to the Schwab YouTube coaching channel. Our next topic is building a stock portfolio, and I am your host, Kevin Horner. I want to thank you all for joining me here today. We are going to be revisiting some of the individual positions we attempted to put on last week. I say attempted because they didn't all go our way, unfortunately. We did manage to get one trade working, but we did have a couple get stopped out rather quickly. And I want to explore exactly how that happened with you, of course, but we're going to get started, as we will be doing in this class going forward, with a brief market review, kind of setting the table for our top-down method and approach to putting some money to work in a stock portfolio. So thanks for being here, everyone. Today we're joined by Connie Hill in the chat, so you can say hey to Connie. She'll get to comments and questions that I'm unable to get to today, but of course I want to hear from you nonetheless, so please do feel free to post in the chat for the duration of our show. We'll go about 45 minutes, and I will certainly keep an eye on what's going on in the chat so that I can bring your questions and comments to the discussion as usual. So that will be the plan for today. All right, real briefly, if you're not already doing so, please follow Connie and me on X, Connie Hill CS and Kevin Horner CS. Doing so with us coaches is the best way to find us when we're not offering these classes for you, of course. So find us, follow us on X, and engage with us there. All right, let's get to our disclosures, and then we'll jump right into the discussion today. Please remember first that our discussion is exclusively for your information and your education. We are not in the business here of making recommendations. We will not endorse a specific approach to trading. What we will be doing is offering up insights that traders might choose to employ in their own processes. We will discuss tenets of technical analysis, some of the basic concepts and strategies that traders might use. But it's important that you do your own due diligence and understand a process that will work for you. Remember, the process that we choose to work with is one that needs to be relatively simple and easily repeatable. That's what we're striving for, is consistency in our process. It's okay. As a reminder, we're going to have trades that take losses for us. Our goal is to have our winning trades in terms of the dollars return better than our losing trades. And that means we can have more losing trades. Our goal is to keep those nice and small, but ultimately building out a portfolio that we hope will allow us to manage trends, manage risk along the way, and own these positions for as long as possible. So that's going to be our step today, everyone. We're going to jump right in to that process with a look at how we finished the regular market today. So we're going to start us off with a quick peek at the S&P 500. There's not a lot that we can glean from what had happened today. It was a very quiet day across the board, really. The SPX hit new all-time highs intraday just yesterday, but we've not made any moves to take us off trend or anything like that. So if we are, simply put, riding the trend, trading the trend, the majority of traders are probably eyeballing that 50-day moving average perhaps, but if you're a shorter term trader, it might be that orange 20-day moving average. They're not too far away from each other. They're only about 35 or 40 points away from each other, but the shorter term one, the 20-day, has actually been held for a while here since we recaptured it back here in late November. We did have that quick hit bump with the 50-day, and then we got right back on trend. So it seems like the path of least resistance has been to the upside, but that doesn't mean it has to continue as such. We as traders probably still need to be thoughtful about where is it we would choose to take some action. For a lot of you, it might be that 50-day moving average, because under the 50-day, the odds increase for a deeper pullback. It doesn't mean it has to go that way, as you all know, but that's where the odds change a little bit. And as traders, that's where we might want to make some decisions. So for the time being, not a lot of concern, sticking with the trend here, and we'll continue to see if that will continue to work for us. If we move into the NASDAQ 100, we'll see similar price action in here today. Very mild day across the board. The notable takeaway is that we once again have struggled to make higher highs. I'm going to extend my line here for just a few extra days to the end of this week. And you'll notice for now, 3 days in a row, we've had trades that took us through that ledge of resistance intraday, but we've been incapable of closing above it. tells me yet again that we continue to struggle to break through. There appears to be overhanging resistance here that keeps us from popping through. Obviously, that doesn't mean we aren't going to pop through, but if we are trading the trend, we don't right now have a good reason to be buyers right here, because simply put, if we continue to see what's played out recently over the last few months, well, then we have every reason to think we should get pushed back yet again. So if you are waiting and simply patient, you're waiting for a better risk reward setup, that changes with a new high short-term close above that white line. And we still don't have that here. So waiting with patience is one of the hardest things to do, obviously, in watching the market. You want to be participating as early as we can. It's human nature to want to get into the trade beforehand. But if you're patient and waiting for confirmation, in the NDX at least, we do not have it as of yet. Now, let's take a quick peek here at the small caps. Our Russell 2000 did make a new all-time high close today. That is not a negative. That is not bearish. The candle is red because our price action today was at the close lower than we were at the open. But nonetheless, this is still a new high and a breakthrough what was prior resistance here on last week. And we took it out with Thursday's close, and then we've had continuation thereafter. So, this is actually a nice development for the small caps here, popping through from, this ledge here at around 2480 or so, and then we took that ledge to 2590. So if we were going to ballpark that to about 100 points, some traders would look at this and say, well, that gives you the neighborhood of about 2680 to 2690 to the upside in the Russell. That's just based on the measured move calculation, the height of the range from which we've broken out. And then that range time frame, say, for example, we could start it in December with the peak, or we could start it with the beginning when we move through it. But really, it's been about 5 weeks of price action sideways there. And then we can start to consider maybe somewhere in the neighborhood of 4 to 6 weeks of upside opportunity that could bring the measured move into play. Obviously, the biggest takeaway as it relates to a measured move, if this is not your first class, you've certainly heard me say this. If it is your first class, listen up. This is a good one to remember. But measured move targets, my calculation, your calculation, even an analyst target price, these are never guarantees to be achieved. So for you technical traders, they're simply estimations and ways that we can try and manage our risk and set targets. But as much as I'd love to tell you they're all going to happen and play out that way, they certainly do not. So with that in mind, everybody, let's move ourselves through the sector review of details here. So we've had some movement in the major sectors, of course, the 11 domestic sectors of the U.S. market. And the biggest difference of late has been that we've not had leadership from technology. We've had alternate groups leading us. This may not surprise you because, as you saw, we've had the S&P and the Russell continue to make higher highs, but the NASDAQ is kind of struggling, right? And the NASDAQ, of course, has a different relationship than the S&P and the Russell. NASDAQ very heavy on technology, whereas the S&P and the Russell have much greater components in, for example, financials and industrials, both of which have managed to have big moves to the upside. If we look at this on a 21-day basis, we're going to see relative strength and outperformance from materials, from industrials, from communications, and then a little-known sector of energy. Yeah, we'll look at energy. Why not? We can talk about that a little bit today. And we also today had a significant move of last week or so, really, in the staples. And actually, we're going to start off with staples today. I thought we could do that to get us started on a new position, a new possible trade here that we're going to consider. So let's do, and I say trade, of course, we're talking example trades. You all know that. But I'm going to back out my chart. And I wanted to quickly just highlight the move in energy. Energy has taken out that triangle consolidation window that we've been talking about. And then today, after all of this volatility we've seen, it's actually managed to trade outside of that slight down slope to the price action of the last week. The bigger line is that downtrending red line. Check out this on a weekly basis, and you can see that it doesn't really catch your eyes as much, right? What really catches our eyes is probably the fact that we have been really consolidating in this space for the majority of the last few years. And that is actually likely tied to the fact that we made such a significant move post-COVID when we took basically oil down to nothing, right? When we get down, make big moves like this, we need time to digest. And it looks like that's what we've done. It has not run its course just yet necessarily, but it sure makes the view of it kind of stand out, doesn't it? So, this whole range in here is what we're talking about. And now that we are basically at the top of the range, many traders looking to see, can we get outside of it? Can we then carry energy higher? And can it maybe carry the broad markets? Remember, when we go through these phases, it's not often that energy is the leader in a stronger bull market. It's often that comes from technology. So this would be maybe a reminder of perhaps the stage we might be in, later stages of a bull market, as opposed to the immediate beginnings. But we know that because, well, we know that the S&P's been trending upwards since the conclusion of 2022, which was, let me see if I got that right, the 23 year, which was our rough year in the market, right? When we had that big pullback, we had a good 30% drawdown in the S&P. So, this might not be necessarily what we want to see from the broad allocation of the market leadership from energy, but it is notable nonetheless. Now, the spaces that I really wanted to focus on was that, like I mentioned, that Staples Group up 1% today. Notice the significant development here over the last week or so. There's been a lot of conversation. First of all, the biggest deal is the fact that we're back up above that 200-day moving average, right? This little consolidation lines I drew in really aren't helping us out anymore. And so now what we've done is managed to trade through that 200-day with some serious conviction here. And, this is a bit of a heads up. There might be opportunity in here. In these latter stages of bullishness, traders get to be a little less invested or comfortable, perhaps even with the growth side of the market, and they might lean more towards value. It's often stated that you might find more value opportunities in Staples positions. Staples areas of the market tend to pay dividends, tend to be more value oriented, lower earnings, lower price to earnings ratios, and many traders will start to lean that way in these periods. Well, if this is in fact a breakout in Staples, it could provide some ideas and opportunities. And so one way we can do that, of course, is we can utilize one of the scans that I've been talking recently about. It's my uptrending all time frames. Now, of course, that's not really fair to suggest it's not uptrending in all time frames, but all the time frames that I have been watching the market, a 20-day moving average as one example, a 50-day moving average, and a 200-day moving average. So ultimately giving me a snapshot in time of the securities that are trading above all three of those moving averages in this single space, that being consumer staples. Now, that doesn't mean that these are going to provide necessarily entry opportunities based on your first look. This is going to likely become a list that's one that we're going to want to reference and review frequently so that we can find the ones that are properly positioned at an area of support, for example, where we'd be comfortable and confident to expose new money. So this list, I'll give you I will absolutely share this with all of you because I think that this scan can be helpful. And what I want to speak about briefly is just what we have designated here, which is specifically stocks in the S&P 500 and that are consumer staples exclusively. That's all we've done. So if I share this with you, the important aspect is to make sure that you save the scan query, give it a name, right? Define it so that it's obvious and easy to locate. In this case, something like uptrending, 3 time frames, staples, right? And then that'll make your ability to locate it next time very simple. And you can also then simply take the drop down after having saved that query, change the drop down. In fact, let me just go ahead and save this here to make sure I've got it. I'm not certain that I do. Yep, so it's uptrending time frames, and I'll just say staples. There we go. And so here I can just change staples, go down to by industry. Let's make this one all energy. Let's see if we've got any. There's 14. Great. So now I can save that, scan query, and make it the same thing, except now I'm going to save that as energy. Right? And then one more time, what about, well, financials made a pretty good pullback today. Oops, let's see here. Yeah, they pulled back, might be at support, right? I mean, these were prior highs. Maybe if I would adjust this line a little lower, these were right in here, prior highs. So, you look at where that lines up, comes pretty close to the 50-day moving average. Financials might be in need of a 50-day moving average test in here, but still a group that's better than many. But once more, I'm just going to change this to financials, and then I will go ahead and hit scan, and then I'm going to save this. And again, I'll share these with you, share one of them with you. And again, all you have to do is just alter the intersect with so that you can have them all that you want, any of the sectors you want. All right, financials. And so what I'm going to do now is clear out the intersect. And so this will just be uptrending all time frames. And that way it's more or less the generic version of this one, everybody. Uptrending all time frames, clear that. There we go. So this way, all right, share this. So this way you should be able to simply navigate your intersect with and make alterations as you see fit. Now remember, everybody, these scans are not guaranteed for timing, not guaranteed for accuracy. They're not a recommendation for you to use them. But if you're going to use them, remember many of these scans will be required only in the live version. In paper money, you might not be able to pull some of the study criteria that we've designated this one with. So you might load this in your live version if you're going to use what your results are giving you. Then to trade or to make example trades in paper money, you might just simply need to create a watch list, save that watch list with yourself so that you can get it from the paper money side of things. But that's one way you might go about doing it, everyone. Let's go ahead and change my drop-down menu to my watch list. We're going to select the uptrending all time frames staples list, and that's going to then launch right here. Great. And we're going to take a look at a staple stock here. What about Tyson? All right. Now, so when we're giving consideration to stocks that we want to potentially own in our example scenario for this class, we want to do so early on in new trends if we can. If we're buying in the midst of an uptrend, there's nothing wrong with that either. But if we can jump into a position early on in a newly developed uptrend, it may offer us the opportunity to stick with the trade even longer. Now, the couple of things that stand out to me here on Tyson Foods. Number one, we're closing close to the most recent high. In fact, this is probably the highest close we've seen because our high close here was 59.91, and then the next day we closed at 59.53, and today we closed at 60.08. So we've basically got a new short-term high close, or at least the highest close we've had since May of 25. So this is developing quite nicely. Let's talk about some of the trend things that are most different. Number one, we see that we've got a well-defined broken down trend right about here, right? We caught this mid highs that we had here in the summer. They acted as matching highs. Again, matching highs in a downtrend are considered to be rejections, right? And that's exactly what happened. We got rejected right here at the white line. Make that a red line just for further evidence. So we got rejected, and then we ended up making new lows, all right? We made new lows here at $50.56 or so, but our RSI was working a little bit differently. So we had this down slope as we made a new low in price, but down below, you'll notice we were really oversold in early October. And then the RSI, even though the prices made a new 52-week low there, RSI made a higher low. Now, reminder that this is known as simply a bullish divergence. Bullish because the price made a new low, but the RSI made a higher low. And the thought process is perhaps that validates that current low being established and might give traders comfort to perhaps start a new position right there. In this case, this was, to that point, at least our low in the trend. Now, what's gone on of late, once we took out the downtrend line, was a breakout and a throwback to support. That line kind of coincides with this test right here, right around 55.5. So this is very intriguing. So if we started targeting this, I'll just, for our purposes, we're going to make this cleaner. We're just going to call it 56. I like rounding our numbers off. Makes it a little easier on us. All right. So here we've got 56 and here we've got 60 approximately. That means that if we can break out, we might have an additional 4 points of upside, which could take us to maybe 64, 65. And then we look back here and we see that the last peak in the last year, 52 weeks, has been pretty much 64 and change, right? So it gives us what many would say is an appropriate, approximate target. Doesn't mean we have to sell there, but it gives a short-term target, okay? Now, if we wanted to use Tyson to establish a new position for exposure to the Staples space, we could choose to do so now. Maybe be, admittedly a little bit risky because under 56, our tune would change, and that gives us about 4 points of risk. So by the numbers that we work with here, those numbers being tied to our full position size versus a partial position size and so forth, and our tolerance for risk, we probably don't want to exceed about 100 shares. We could, if we were willing to ride this for $1,000 maximum loss, but we're just in the process of getting our feet wet. And I think it makes perfectly fine sense to go ahead and own a small 100 share position. We'll have an exit strategy that would come into play if we traded under 56 and probably under 55, because the recent lows in here have been around 55.40. And so we want to see new short-term lows actually on the chart. And if those short-term lows happen, well, then we don't want to participate, because then our likelihood increases that prices can go lower. And we don't want to stick around for that. So we'll go ahead and start a new position with a stop order on Tyson under 55 approximately. So I'm going to do that as an example trade with a right mouse click and a buy custom. Now we're going to do it with a stop, but not with a target. And that's again because I want to get into the trade and I want to manage my process along the way and maybe be a seller at any number of higher prices. But most important, my goal here is to mitigate my risk. So we'll use the traditional plain vanilla stop that once triggered becomes a market order to sell. And that of course means we can't guarantee any price on a sale if we trigger, okay? So the first thing I'm going to do is I'm going to limit our trade for purchase tomorrow to $60.50. Yes, that's higher than the open here, but this way we have an opportunity to buy if it opens close to where it closed today, and we can be in the trade, but we've given it a little bit of wiggle room. I call these the padded limit order, okay? So it increases our likelihood of execution, doesn't guarantee it, but it also, while increasing the likelihood of execution, remember the limit price is always considered or better. So if it opened under 60.5, we're going to get the better price. We're not going to pay 60.5. Okay. So down below, I'm going to change my exit to good till canceled, and we liked it under 55. So I'm just going to go there, and then beneath it by a few pennies, let's go down to that 94, just a non-round figure. Just give me a little extra wiggle room. And again, good till canceled. Okay. So just want to make sure that it all lines up. 100 shares to buy, 100 shares to sell. All right. Confirm and send. Let's just make sure not to exceed 60.5, and the stop at a trigger of 54.94. But remember, we have gap risk. So if we are above it, above the stop level on any given day, and then the next day we gapped much lower, our execution is likely at the much lower price or close to that, not so close to our stop price. So please bear that in mind. All right, so that one is set up for tomorrow's business. Now, let's go back to that staples. Let's see what else is in the chart that might be intriguing. And sometimes, you've seen me, I generally stick to the daily chart in here, but I don't mind looking at the weekly as I'm doing what I reference as chart triage. I just want to see if I can catch some of these newly developing patterns early on. Let's take a look quickly at Target. Target here, this is a little bit interesting. It has made a recent short-term low around 84, happens to coincide with some prices that were previously acting as support, former resistance in here could be considered to be support. What's interesting now, look at how high this is pushed. Could this be potential resistance? It certainly could, but it could also be notable if we happen to move through it, right? So we may be just making note of that. That doesn't look too bad, does it? On that Tyson trade, the chart was reflecting a 50-day crossing a 200-day moving average to the upside. You can see here, we're getting awfully close to the exact same thing. And I'm sure many of you are familiar with what that is, everyone. That is the so-called golden cross, right? The golden cross is the 50-day crossing the 200 to the upside bullishly, implying for traders the potential of a new trend. And the last time we got the 50 over the 2, it's been a little while. We have to change our time frame, don't we? Let's go back, make it 3 years here on this daily chart. So here we are. We crossed. We crossed very, very briefly way up here in October of 24, not last year, 24. But when we originally took out the 50 crossing the 200 to the downside, it was right here in August of 24. And you'll notice that while it was capable of making moves back higher for a while, it was also enough of a heads up that the trend may very well be over. And in fact, it was, right? Because even though we got into prices above this white line that I'm drawing right now, we didn't make legitimate higher highs. We had 1 day or 2 day above it, 1 day, 2 day above it, and then it was downtrend city from there. Now, this Target trade certainly could be something under development. If we look at what's gone on recently, the relative strength indicator is through 70 to the upside, which is a notable scenario given the downtrend that we're looking at over this 3-year window, everybody. So, this Target could very well be an example trade for us here. We're close to it, but I think given what we have seen, let's force this one to validate itself. Let's see if we can work through this 108 level over the next week or two. This might give us an opportunity in the near future. Remember, if we're simply relying on our watch list, as we should be, you're not going to find each of these scenarios to be an ideal setup at any given moment, but it's important that we work through as many of these as we can. We evaluate and consider. We know the prices where we would like to take action. You know what? A rejection at this 108 level, if it came back for a 20-day moving average test and settled and basically held the 20-day in here, that becomes a very intriguing spot for the beginning of a new trade. And we don't know how we're going to act as we trade at this upper range. So forcing the security itself, forcing the price action to validate might be helpful. It can be difficult. Don't get me wrong. As traders, it's difficult to be patient sometimes, but we might need it. So we're going to keep Target on a watch list. In fact, I've also got another watch list that I've got set up for this class. I'm going to add Target to that one because I think it's important that we continue to look at the stocks that we've come across and we aren't ready to make purchases on. We don't want to forget about them. So I'm going to go into my building a stock portfolio. Let's see. Oh, maybe I haven't called it that yet. All right, so let's go to the one that was called quotes. And that one is, nope, I can do math, or I know the alphabet, QRS. So here it is. Oh, it's not there. Huh. Whoa, there it is. Potential, I forgot everybody, I've already changed its name. So potential bullish opportunities, I think is what I called it. There we go. I'm going to add Target right there. All right, sorry for my own confusion there, everybody. So I thought that was a little interesting there on Target. We placed that trade on Tyson. Let's go ahead and look at one more in here. I'm just going to flip on through these charts. There you've got Estee Lauder at new highs in the short run. Kind of recently missed a boat on that one in the last year, haven't we? You've seen this in consolidation in here for a bit. This was a significant move through when it finally recaptured that. This was kind of nice. Got itself going, working against that 20-day moving average. We're probably not surprised by that. There's Walmart moving to some highs there. That's nicely developed. In fact, if you've been waiting on that one to move, wow, look at that against the 20-week moving average. Their 40-week, excuse me, everybody. Long range support above the 40-week. That's kind of notable. This looks like a bull flag breakout, doesn't it? So let's see if we can get another developing bull flag pole that would follow with a flag cloth portion. Perhaps we're afforded a chance to be buying along the trend line, which would be a little bit more comfortable for many traders. Let's keep on moving here. How about Archer Daniels? Moving to the top of its range. Dollar General moving to a peak up here. This is kind of an intriguing move, right? I mean, I hear all the time, I don't like buying as it breaks out, everybody, you know what? And then I see things like this, right? Breakout, quick bull flag for 3 days, right back in path. Another possible flagpole building right now. That one looks intriguing. Might be nearing a breather spot, right? This is a new trend. And very new, because look at for how long we've been below. In January of 23, we broke that 40-week moving average, and then we got back into the 40-week in April of last year. So, you know, look, technical analysis 101, right? Look at this. Resistance, resistance, resistance. And I know many of you will say, but Kev, what about this period when it was above the 20-week? And I'd say, yeah, you're right, it was. But where did it go to? Right to here. This is still a lower high than this right here, correct? So in order for us to suggest that, oh, that was a legitimate breakout, we would have had to at least trade above the last highs to believe that that was no longer downtrending, right? Well, in this case, it really just kind of took a month to go sideways, and then it rolled over, made that lower low. Now here, when we recaptured it, this was the same kind of thing right there, except that this one is when it moved higher, right? And so what did it do? It went sideways for a little bit, even tested the former highs in the breakout before making the new high, pausing, allowing that moving average to cleanly get caught up with price action. That is not an uncommon scenario. So this is a nicely developing new potential trend here, but given our proximity to the recent highs where we last took our pause, it might be pertinent to wait and be patient. All right, let's see what we got in chat here. Thanks, Ricebird. Always appreciate that. Yeah, I'll tell you, scanning You hear me talk about it in the Trader Talk workshop or Trader Talk sessions 4 days a week. We talk all the time about the top-down methodology. It's simply trying to work with the same stocks that everybody else is trading. We want liquidity. We want to be trading the leadership groups. They become easier to manage, and a trend that's in play and traded by multiple people, the more people that are trading it, the better. It makes it a more reliable trend. Doesn't mean it makes it a more an easier way to profit or anything like that necessarily, but it may make it a more reliable trend. So that's what we're trying to accomplish. That's it. And top-down methodology can help us do that. And then speaking to that consistently in this class, I think, is where we're taking that discussion to the next level. Let's see. Okay, how about we got to go look at what happened last week. So we're going to jump back to my monitor page, activity. We did get ourselves into the Caterpillar trade, which is excellent. So let's go see how Cat's doing here. We're going to go to the daily on this one. And I have added in my orders, so both my entry and my existing stop order here. So when we look at this, we had a entry with a stock that's been moving up for a while. Look at the 50-day. In fact, if we just applied only the 50-day, you'll see how clean it's been. This has been a lovely developing trend since April, May of last year, at least early mid-May of last year. We've been moving nicely upward, testing along the 50-day moving average, and we built in our current stop based on the average true range, or ATR, below the 50-day moving average. Today we moved to new all-time highs. That's great. We don't necessarily need to make a whole lot of movement here. Our stop is currently at 560, and our 50-day is at 581.69. So are we maybe a little extended below the 50-day moving average? Maybe. Our ATR is just shy of $16. So in theory, we could possibly move, our order up about 4 points if we wanted to kind of lock that in. But, given this price level we're looking at here, that'd be a move up in our stop of less than 1%. I'm not sure that that's as important as keeping a wide stop active, which will give us the benefit of taking us out at a level we've already admitted, based on the math we did last week, that we'd be comfortable getting kicked out there. Because yes, we'd take a loss on those 15 shares, but it would be a loss that we're comfortable with based on everything associated with, everything associated with our position sizing and our risk tolerance not to exceed $1,000. So that's really what we built in there. Okay, so Caterpillar, working great. Now, let's talk about what didn't go so great. So first of all, we're going to go back to the activity, the monitor page, but not activity and positions. We're now going to go to statement. And in the statement key, or statement Q, what you're going to notice is, here's the trade we got. Basically, we got executed and immediately stopped out. So this Credo trade didn't quite work the way that I had hoped. Now, it didn't work the way I had hoped because of the way the stock opened on last Wednesday after we had placed this trade. So I'm going to show you how this went. We placed this order with a little bit of wiggle room. We asked it, hey, get us into the trade as long as it does not exceed, 133. We gave it wiggle room. We wanted to be in the position. The problem is that the entrance into the trade was such that we got stopped out immediately upon our execution. All right. So that's the frustrating thing, because even though we got bought in at the right price, our order was to exit if the stop was if the price was under or equal to 127.88. Well, unfortunately, we got an excellent price for entry, but then it was immediately executed our stop order because it was also below our stop. I didn't expect us to get a shot to be a buyer 5 points, or even in this case, 8 points underneath it. It just happened to be that way it worked. Now that stinks because look at what Credo has done. So last week, the thing that I heard from many of you was, Kev, this doesn't fit the parameters of an entry. You're buying at an uptrending stock, sure, but it looks terrible. It was sitting on this this ledge of potential support. Well, it happens to have moved off of it quite nicely. If we would have set that trade properly, or perhaps put us into the position without an immediate exit strategy, we would still be in the trade and we'd be up 25 or 30 points. And I'm fairly annoyed, if I can be honest with you all, fairly annoyed that I don't have this one on the table here for us as an example trade. Given what we're seeing, we could choose to go ahead and put this trade on again and looking for an exit under 125, for example. But all of a sudden, now we've got to take on a substantial amount of risk if we're to do so. So if we want to consider that what we've seen here might be successful tests of support over multiple windows of time, like right here, possibly that one right there, and then of course this one right here. If we're going to look at all of those and say, yeah, we like 128, 129 as real legitimate support, and we're back up above the 50-day for the first time since we fell through it back in December, maybe traders are comfortable putting this on, and let's see if we can get this one to start trending from here. If we can take out some of these upper levels of resistance, remember, once we've developed a consolidation or sideways range, traders expect a breakout to get trending thereafter. So if this can, in fact, break out to the upside from the range we've established, then we might see this start to trend further upward, right? Now, obviously, we don't know that that's going to go that way, but it could start trending to the downside if we took out the green line to the downside, right? But for the short run, given what we've seen off the bounce, I think it might make sense to go ahead and position a small amount here for the trade. So we went ahead last week when we put this on. We did it for a total of 18 shares. We kept it very tight. We can do that even still. So let's just try that. Let's go ahead and put that on, and let's not go with the stop, but let's see if we can run with that one for a little bit, just for giggles, because I'm still annoyed that we didn't get to keep the position here. So we'll go ahead and put a buy, but not a custom buy, because we're not going to put in an exit strategy here. And we're not going to buy 100, but we're going to buy a more appropriate, what about 20, which would be about a $6,000 position. Yeah, I'm good with math. About a $2,600 position, 20 shares, 2,600. And you know what? This way, if we do get thrown back to that green line here, well, then this could give us an opportunity for entry. So we are working with a full position size of 10,000. So we could go for half a position, 20 share or 50 shares. Well, let's see here. Let's just do the math. Let's do $5,000. And so I'll just take the current market value at the close today was 161. Let's round that up to 162. And divide 5,000 by 162, and that says we could do 30 shares for a proper half of a position. And then we'll just see if we can manage it. Now, I like it, Wiley. This is a good example of potentially revenge trading. You're right, and I'm going to do it not because I think I want to validate revenge trading. I want to see if it hurts us or helps us. Again, we know we should not be revenge trading. The stock doesn't know us. The stock doesn't care where we own it or anything like that. So, it's important not to overthink this. So we're going to round that entry up to 162 limit. And if I'm not mistaken, that should be about 5,000. Yeah, 48.60. So this way we can try it. We can see if we're right. We're not going to have the stop, so we are at a little bit of risk. All right. Now, let me see here. Alfaro, you might be right. It may have run course. For some of us, it might not be ideal. It's only one day above the 50 day moving average. But if this is rallying and continuing for us, we might be in the midst of a strong push. Now, look, in the other takeaway here, look at where that volume has been of late before I place this. Volume has been picking up off of that low. So we'll see if this is, I'm not gonna argue with anyone's viewpoint here. All right. We're just gonna see how it goes. We're gonna find out. So we'll let this one go. Let's go ahead and put that in. And then we'll come back to this one, of course. So 162. All right, there we go. All right, now the other one that we tried last week for our example trade was, let's see here, I believe. Let's go back, and it was, oh yes, GEV, GE Vernova. So here we did have the entrance at our limit, and we got stopped out pretty quickly. So let's take a look at GEV. Just wanted to highlight this one once more for us. Now, this one we built last week based on that 20-day moving average, right? So we had been looking at this. We'd had a break of resistance, and we had pulled back to the 20-day moving average, and we had hugged it for basically all of the last 2 weeks prior. Well, we got taken out very quickly, and we're right back at the 20 there. We're going to let that one go. We're not going to follow the standard on this, but I'm certain there are traders. Let me remove these orders so that you can see this. Actually, not orders, trades. So notice how here we've got the 50-day coming into play. That is not a real shock. But the thing that's frustrating to some traders, of course, is you build that trade working against the 20-day originally, you get stopped out, and then you find that it finds support at the 50-day. Some would be very quick to jump right back in and work against the 50. Others want to see it, give it a little bit of patience and see what comes from here. No argument. We'll see how that goes. We're not going to place that one for you at this point, but we are going to keep an eye on it in our watch list. So with that, we'll wrap our time, everyone. I appreciate you joining us today. Obviously, lots to cover in this class going forward, and I do enjoy the ongoing back and forth. So thanks for being here. Thanks for Connie and managing the chat. Follow us on X, Connie Hill CS, Kevin Horner CS. And if you like the discussion, hit that thumbs up. That thumbs up down below for us. Of course, that always helps us out in the replay, and I'll get this one out as quickly as possible. So thanks for being here, everybody. Have a great rest of your Tuesday. I look forward to catching up with you again real soon.